Ever wondered what happens when interest rates drop? Well, let's dive right into it. Interest rates are like the heartbeats of our economy. They play a crucial role in the financial health of a nation. They dictate the cost of borrowing money and the return on savings. When interest rates drop, borrowing becomes cheaper. People and businesses are more likely to take out loans, leading to increased spending. This can stimulate the economy in the short term. Sounds positive, right? Well, it's not that simple. Low interest rates also mean lower returns on savings. This can discourage people from saving, which might not be ideal for long-term economic health. It's a delicate balance, really. Moreover, if interest rates are already low and the economy takes a downturn, the central bank has less room to maneuver. They can't lower rates much further to stimulate spending. And let's not forget about inflation. Low interest rates can lead to increased spending, and if this spending outpaces production, it can result in inflation. Lower interest rates may sound appealing, but it's not always sunshine and rainbows. So, lower interest rates mean cheaper loans, right? But here's the catch. Indeed, lower interest rates can make borrowing more affordable and accessible. This, in turn, can lead to an influx of buyers in markets like real estate. Now imagine this, an influx of buyers can cause a surge in demand. And as we know, an increase in demand without a proportionate increase in supply can lead to price inflation. In the context of the housing market, this can mean overpriced homes and an overinflated market. But that's not all. This situation can also create economic instability. When interest rates are low, it's easier for people to borrow and spend. However, if people overextend themselves, it could lead to a higher default rate on loans, which in turn could trigger a financial crisis. Moreover, critics like Joe Brown, Jeff Snyder, and Stephanie Pomboy suggest that lower interest rates might be a misleading tool used to support current administrations or justify higher interest rates in the future. An overpopulated market might just be the tip of the iceberg of the negative impacts of low interest rates. So, while it might seem like a good deal at first, lower interest rates can have a complex ripple effect on the economy. Let's consider the bigger picture now. When we talk about interest rates falling, we're not just talking about cheaper loans or more affordable homes. We're talking about a ripple effect that can touch every corner of the economy. Lower interest rates can lead to potential inflation as more money is circulated in the market. Simultaneously, your savings could take a hit. With lower interest rates, the return on savings decreases, pushing people to invest in riskier assets. Now, let's not forget the criticism of the Bureau of Labor Statistics jobs report. Some experts believe that the data presented may be flawed, suggesting a shaky economy and a looming recession. This means that while the prospect of lower interest rates might seem attractive, it could be indicative of an unstable economic environment. It might be tempting to jump into the market when rates are low, but remember, these lower rates might just be the calm before the storm. So while low interest rates may be enticing, they can cause more harm than good in the long run.